Okay, good evening to all of you. Okay, and last time met, we were discussing on how we determine the company cost of capital. Okay, that's what we were discussing last time. How we determine, okay, the return the different providers of capital expect to receive for their investment in the company. Okay. And essentially, we did say that we need to first know where the money came from. Okay, first need to determine who has been the person providing the company with finance. Okay, is it from the bank? Okay, is it from equity shareholder? Is it from the private shareholder? Okay, so first step is determine where the money came from. Next step is to determine, okay, what referred to as simply the cost of capital from each of those individual capital providers, okay, trying to estimate, okay, who gave the money, okay, what return now do they want, okay, if the company has been financed by a private shareholder, what return do the private shareholder expect for every dollar of investment that they have made in the company, okay. If the money came from a bank loan, okay, what interest do the bank expect at the end of the day? Okay, of course, we ought to factor in the interest tax shield. Okay, so once you determine the return, the different providers of capital, correct, the next bit is determine what is the weight, okay, of each of those capital sources. Okay, what is the weight, okay, for each of those capital sources. Okay, if the company obtained money from equity shareholder, what is the weight of the equity capital? Okay, if the company obtained the money from bank loan, okay, what is the weight? Okay, that is the next step. Okay, trying to estimate the weight of each of the capital sources. Okay, essentially, we said it is better for us to use the market values. Okay, it is better for us to use the market value as a weight. Okay. However, there could be some finance sources, there could be some capital sources, okay, where it might be hard, okay, if impossible, okay, not determining their market values. For example, in the case of a bank loan, okay, you can't go to get the market rates. Okay, therefore, in that case, therefore, what do? We use the book values. Okay, in the case where it is not possible for us to estimate the market value of a capital source, okay, in that instance, then we can use the book values. But essentially, we prefer to use the book value as the market value as much as possible. Okay, we prefer to use the market value as much as possible. Why? Because they do estimate for us what is the current weight of that particular finance source. Okay, what is the current weight for that particular capital source. Okay. And of course, we avoid the biasness. Okay. For example, in case you have to use equity, okay, if you have to use the book values when it comes to estimation of the cost of equity, then again be underestimating, okay, or the contribution of equity, cost of equity towards the entire company with an average cost of capital. Okay. I think that's what we did discuss the last time that we met. Okay. Now today I want us, okay, to cement on the ideas that have been discussed so far. Okay, I want us to discuss on some more questions. Okay, which I think I have sent on our group. Okay, on our WhatsApp group. Okay, there's some list of questions which I have sent you there. Okay, so I would propose that you go through those questions. Okay, then give you exactly what question I want us to discuss on. Okay, so on those list of questions. Okay. So I hope you all have access to those questions which I've sent on the WhatsApp group. Okay. Okay, so those is a question. Okay, so the question I would want us, okay, we shall not attempt all of them. Okay, the main idea is that I give you some more questions, so it's upon you now to try to attempt the others. Okay, so go through question two. Question two on the question I've sent on the group. Okay, question two. So take 2 minutes. Okay, go through it. Then we attempt to it together. Question two on the question on the group. Okay. Okay, I presuppose that you have gone through the question. And what is required of you here in this particular question, okay, of the cost to get the company cost of capital uh, based on the market values, okay? When it comes to getting the weight, okay, we are meant to get the weight based on the market value for each of the capital sources, okay? So if we suppose that you have gone through the question and understood what is expected of you, okay? So going back here, okay, for this company, as we mentioned, the first step, of course, is to determine where the money came from. Okay, for this company, they have ordinary share capital. Okay, they have ordinary share capital as one of their financials. Okay, ordinary share capital is equity. It showed you have equity here. Okay, so you have equity here. I could, sorry, because I seem not to be doing very well. So we have equity, okay? We have also the debt here, and the debt, we have convertible bond, okay? The debt is in form of a convertible bond, and we have 5% preference share, okay? So in short, for this company, we can see that the finance is coming from three financials, okay? We have equity, okay? We have 10% convertible bond, okay? And you have the 5% preference share, okay? In this case, the overdraft, as per se, in itself, it is not, we cannot say that it is a capital source. It's a finance source, okay, but not a capital source as per se, okay. So we may choose to ignore it altogether, okay. So yeah, actually, that's one of the assumptions that you can put across, okay. That even though that the overdraft, okay, has been persistent, okay, we chose to ignore it since it is more of a short-term finance source as opposed to being a long-term financials. Okay, so you may choose not to include it in the analysis. Okay, if you opt to include it, okay, there's another assumption you can make. Okay, that you did assume that overdraft, okay, since it has been persistent, okay, over the last few years, you did include it as part of your capital source. Okay, so it's you to make the decision as to whether you ought to include or not include in your analysis. Okay. So for my case, I choose not to include it. Okay, it's more of a shorter financials as opposed to being a capital source. Okay, financing of long-term capital, long-term assets of the company. Okay, so those are three financials. Okay, that's the first step. The next step, of course, is to identify the cost from each one of them. Okay, identify the cost from each one of them. Okay, so going back to our board here. Okay, so you've said that this company, okay, is financed by the resources. Okay, the first step is cost of capital. Sorry, trying to determine capital sources. Okay, trying to identify capital sources. Okay, capital sources. You say that this company is financed by equity. It is financed by bonds in form of debt, and it is financed by preference share. Okay, it is financed by preference share. Next step is to get the cost of capital from each of those sources. Okay, cost of capital. So A can begin by getting, I agree by getting the cost of equity. As per the information you have been given, okay, as per the information we'll be given here in this particular question, okay, you'll be told that this company has an equity beta, okay, you can see this, okay, it has an equity beta of 1.2, okay, it has an equity beta of 1.2. Sorry. It has an equity beta equal to 1.2. Okay, equity beta of 1.2. Okay, would imply therefore, based on the information given, okay, an equity beta as well as you've been given the equity premium here, okay, we have been given the risk-free rate of return. When they apply therefore, you can, out of the information you have, then we can be able to determine what model to use. Okay, as mentioned, when it comes to get the cost of equity, we can use two models. Okay, we can use the dividend growth model as well as we can use the Gordon's you can also use the capital asset pricing model. Okay, so it depends the information given to you to determine what amount should I be applying here. Okay, in this case, of course, you're going to be using therefore the capital asset pricing model. Okay, and as you see, as per the model, okay, as we mentioned, as per the model, okay, okay, the cost of equity is equal to risk-free equity beta, okay, return of the market minus the risk-free return. In this case, therefore, the risk-free rate of return, okay, the risk-free rate of return will be told, okay, going back to the question, will be told is equal to 4%, okay, and the equity premium is 5%, okay, and you told that the equity beta for this particular stock is equal to 1.2, okay. So they have all the information we need in order for us to apply the model, okay. Risk-free is 4%. The equity beta for this particular stock is 1.2, so 1.2. The return on the market, okay, we have not been told. However, he be told that the equity risk premium, okay, maybe just to make a simple definition on it, okay, referred to as equity risk premium, okay, equity risk premium essentially is equal to what is the excess return, okay, also referred to as the market excess return. It's also referred to as the market excess return, okay, excess return. And simply, what is the return of the market portfolio over and above the risk-free rate of return? Okay, what is the return of the market portfolio over and above the risk-free rate of return, which is therefore is equal to RM minus RF. Okay, that is referred to as the equity risk premium. Okay, therefore in this case, therefore the RM minus RF we have it here. Okay, which is our equity risk premium. We be told is equal to 5%. Okay, is equal to 5%. Okay, our equity risk premium, the RM minus RF. Okay. Therefore, give us therefore 10, okay, give us 1.2 times 5 plus 4, which give us how much? You have to be very careful, okay, because 5% is not the return of the market portfolio, it's not the RM, but it is RM minus RF, the excess return of the market, okay, you have to be quite careful, okay. Equity is premium, which is also referred to as the market excess return, is simply the RM minus RF, not the 5% is not RM, okay, but RM minus RF. You have to be quite careful there, okay. You get 10% to be therefore our equity premium. That is from Esther. Someone confirm? Okay. Okay, thank you, Faith. So you get 10% to be the cost of equity, okay. Be careful there, okay. Be careful here that the RM minus RF is referred to as the equity risk premium. Okay, having done that, our next source of capital is bonds. Okay, therefore, I can have therefore this was A, B is cost of bond. Okay, cost of this bond. Okay, now this bond is a bond that is convertible, which implies therefore we need to estimate its conversion value. Okay, we need to get its conversion value, and we need to get also its redemption value. Okay, so going back to our question. Okay, you'll be told that this convertible bond, it has a conversion ratio of 19 shares. That implies, therefore, you're going to be getting 19 shares for every bond you opt to convert. Okay, that's kind of for a conversion ratio. Okay, the number of equity share you do get per bond. The conversion between is going to occur 5 years from now. Okay, in 5 years' time. Okay, the current market value of this bond, the current market value of equity share of this company, we may need to estimate, which is given to us. Yes, if you look at the current market value of the company equity, okay, this part is 125 million. Which implies therefore we may need to work backward, okay, to get the market value per share because 125 million is the total market value of the company equity. Okay. Fair enough. Let's go back to our board here. The conversion value, which is the conversion ratio times the share price in the time of conversion. The conversion is occurring in 5 years' time. Okay, so we may want to determine what is going to be the share price then. Okay. Okay. Therefore, P5, the share price then, we see again is P naught, 1 plus G, the power of 5. Okay, the power of 5 because conversion occur 5 years from now. The current share price is what we need to get. Okay, we'll be told that currently the total market value, the market cap the current market value of all the company's shares is equal to, okay, 125 million is 125 million, which is equal to, okay, the number of shares, we multiply by the share price, by the current share price, by the MPS, okay. Therefore, in case we want to get the current market price per share, therefore it will be equal to 125 million, we divide by the number of shares, okay. So going back to our question, we may want to estimate, get to know how many shares has this company issued, okay. So this company, okay, back to its balance sheet, okay, the total market value, book value of the company share is 25 million. One share has a book value of $1, which implies therefore this company has 25 million issued shares. Okay, because 25 million is the total book value, and the book value per share is $1. Okay, it implies therefore the number of shares issued by this company is equal to 25 million. To give therefore an MPS equal to $5. Okay, they have currently one share price of this company is equal to $5. Okay, this is our P note. Okay, therefore this is our P note. Okay, this is our P note. Okay, then having done that, okay, we go back to our original question. Okay, our attempt to get P5. Okay, you say P5 is equal to P note, which you have here now, 5. If we told that we want to estimate what will be the share price 5 years from now, therefore the growth in the share price, okay, going back to our analysis, the annual growth in the share price, you'll be told is equal to 4%. Is equal to 4%. So the share price, the value of the share is growing by 4% per year into the foreseeable future. So the growth is equal to 4%. Okay. Therefore, we reflect the growth 1.04. Okay, 4%, the power of 5. Okay, this will therefore give us the share price we expect in 5 years' time. Okay, and you get how much the share price then. Okay, we do get 6.08. Okay, 6.08 with the share price in 5 years' time. Now, having known the share price, okay, having known what to be the share price, then now we can now be able to estimate, therefore, what is going to be the total market value of those shares the holder is going to get then. Okay, is going to get then. Okay, therefore, simply, since we know the conversion value, the number of equity shares that you get, okay, we now know what is given the share price then. So now we can estimate what is given the conversion value. Therefore, conversion value, okay, the conversion ratio 19 multiplied by the share price then 6.08. Give us how much with the conversion value? When we get 115, we'll get 115, okay, 0.52 to be the conversion value. Now, guys, in this bond, okay, we are comparing conversion or redemption, okay. Now, I'm not sure. Let's check on whether there's a mention on what should be the redemption value, okay. If not converted, conversion and redemption occurs at the same date in future. There is, as I can't see the mention on the conversion, on the redemption value. So we go back to our assumption, okay? We assume that the conversion of the bond occur at the nominal value, okay? The conversion bond occur at the nominal value of 100, okay? That is assumption, okay? Which of course is worth enough that you put it down, okay? The conversion is occurring at the redemption, sorry, okay? The redemption is occurring at the nominal value, and the nominal value is 100. Comparing the two of them, of course, the holder is going to opt to convert the bond. Why? Because there is more wealth to be earned, okay, by converting as opposed to the redemption. Okay, the assumption, okay, this is actually the assumption I'm making, okay, that this investor is wealth driven, okay, it's an assumption actually, okay, which is, I think is good to put down, okay, that this investor is wealth driven, they was going to choose the option where there is more value to be maximized, okay. The conversion option, the bond shall be converted, or the holder shall convert the bond. Okay. Yes. Okay, the holder shall convert the bond, Okay, seeing the conversion value is greater than the redemption value. Okay, as this is an assumption. Okay, that the investor is rational. Okay, assuming investor rationality. Okay, assuming investor rationality. Okay, okay, that they're going to be wealthy driven individuals. Okay. Okay, having done that, we can say therefore the market value of this bond, okay, P naught is equal to the present value of the interest to be earned, okay, present value of the interest to be earned times present value earned factor 5 years, okay, R%. In the final, you see that you're going to convert the bond, conversion value, present value interest factor, 5 years, R%, okay. So you may want, we have the conversion value, okay. So now what we don't have is to get the interest, okay. We may want now to get the interest. Okay, the interest to be earned. This investor, the interest they shall be earning from this bond for the next 5 years. Okay, so going back to our question, okay, the interest this bond is paying at 7%. Okay, you can see here it is paying at 7% per $100, and there's tax. Okay, so as you come here, there is tax. Okay, so therefore, the interest to be earned by the holder is going to be less 30%. Okay, it's going to be less 30%. Would imply, therefore, the net interest income to be earned, okay, is going to be 1 minus 0.3, that percent be the tax, times the interest, 7%, times the nominal value of the bond, which is 100. Okay, would imply, therefore, the holder shall be getting $4.9 per year for the next 5 years. Okay, $4.9 per year for the next 5 years. Okay, thank you, Charles. Would imply, therefore, the market value of this bond. Okay, going back to our question, the market value of this bond. Okay, we have been told the total market value of all the bonds. Okay, and the total market value of the bonds of this company is $21 million. Now, what's the market value? What's the market value therefore per share or per bond? Sorry. Okay, if the total market value of all the bonds is 21 million. Okay, so the market value per bond is equal to the total market value. We told is equal to 21 million, and you be told, okay, that one bond has a nominal value of 100. One bond has a nominal value of 100. Okay, therefore, what was the total nominal value of the bonds? Okay, total nominal value of the bonds, okay, is equal to 20 million. Okay, we have it here. Okay, is equal to 20 million. The total nominal value is 20 million. Okay, we imply, therefore, going back here, therefore, the market value per bond will be equal to the total market value of those bonds times, okay, I think I should have, just to make it easy, okay, it ought to have been like this, okay, the market value of bonds of this company, okay, is equal to 21 million, which is equal to the number of bonds we multiply by the market value per bond, okay, market value per bond. Therefore, 21 million is equal to the number of bonds. Don't forget the number of bonds for this company is equal to the total nominal value, which is 20 million, divided by the nominal value per bond. Okay, that gives us the number of bonds. Okay, we multiply by the market value per bond. The market value per bond is 21 million. Okay, coming back here is 21 million. We divide by the number of bonds. Okay, to give therefore the market value per bond. Okay, to give therefore, don't forget the number of bonds here. Therefore, will be 200,000, and this will give therefore the market value per bond, which is how much? Give us 105. Okay, therefore the market value per bond is equal to 105. Okay, now having done that, we have the market value now. Okay, don't forget this is our P naught here. Okay, this is our P naught here. Now we have the interest, we have the conversion value, and now we can go to estimate what should be there for our R. Okay, that was the main objective, to get our R. Okay, therefore it's good. You have here P naught. Okay, you say P naught is equal to 105. is equal to the interest, 4.9, times present value earned factor. The number of years is 5 %. Conversion value, we got 115.52 times present value interest factor, 5 years %. Okay. Okay, simply there is a trial and error method. Okay, there is a trial and error method. Of course, reduce the number of attempts. Okay, you're going to make. Okay, what do? You simply determine what should be the cost of the similar bond if that bond was to be redeemable. It will simply be equal to, okay, it will simply be equal to the cost of that bond to be equal to RD 4.9 divided by the market value on 5 and we express as a percent. Okay, to give us 4 points. Okay, to give us 4.67. Okay, we get 4.67. But I say you don't need to do this. Okay, you don't need to do this in the, for example, in the main exam. Okay, you can simply do it from a calculator. Okay, therefore, to reduce the number of trials, okay, the cost of a similar bond will be equal to 4.67. Okay, therefore, you can begin by discounting our cash flows. Okay, the 4.9, the 115.52 at either 4 or at 5. Okay, whatever I prefer. Okay. The only reason I've done this calculation here is simply to get you an idea, okay, where the cost of your bond should be, okay, but you don't need to do that part, okay. Therefore, if we discount, okay, let's discount at 5%. If we discount those cash flow at 5%, okay, what do you get? It'll be equal to negative 105 plus 4.9 times present value added factor, 5 years, 5%. Plus 115.52 times present value interest factor, 5 years, 5%. And what do you get? Okay, it is a trial and error method. Simply, there is a trial and error method. Okay, and you seem to have some answers. Okay, and you get 6.7. Okay, 6.72 positive. Thank you. Okay, so you get 6.72 positive. Okay. That implies therefore, okay, we did not get a 0. Okay, so you can choose our second discount rate. Okay, you can choose maybe 6, you can choose 4, what do I prefer? But let me choose 6 because it's going to give me a figure closer to 0. Okay, so at 6%, the same is the process now. Okay, but now at 6%, okay, it will be equal to negative 105, okay, plus 4.9 times present value earned factor, 5 years, 6%. 115.52 times present value interest factor. Okay, 5 years, 6%. What do you get? In case we discount the same cash flows, but now at 6%, you get how much? Okay, and we did get some answers here and get 1.96. I suppose it's positive. Yes, okay, positive. Okay, 1.96. Okay. Now, having done those two, essentially, therefore, now you can now be able to apply our IRR formula. Okay, you can now be able to apply the IRR formula. Okay, very simply, you're going to say that the RD, the cost of this debt, okay, will be equal to 5%. Okay, plus the difference between 5 and 6, okay, equal to 1%. The value at 5% will go 6.72 divided by 6.72 minus the value at 6%, 1.96. Okay, and that therefore give us therefore our estimated cost of this debt, which is how much? Okay, got some answers here. Okay, and you get 6.41. Okay, 6.41% to the cost of this bond. Okay, 6.41. Okay, and as we estimate therefore the cost of convertible debt. Okay, and we learned that you go back to our early analysis. Okay, we get the cost of equity, which I think we are done. Cost of bond, we have just done. Okay, and then we get the cost of preference shares. The cost of preference shares. Okay. So you're done with the first two. Now it's next to get, we need to get, okay, what should be the cost of preference shares. Okay, so C, okay, cost of preference shares. Okay, cost of preference shares. Okay, what we equal to RP has got to preferred dividend. We divide by the current market value, of course, we express as a percent. So we may want to get the preferred dividend. Okay, so going back to question. This preferred share, they're paying the dividend at 5%, okay, at 5%, okay. Don't forget the preferred dividend, there is no tax on it, okay, not like the interest on the convertible bond, okay. There is no interest on the preferred dividend. So it's simply, you do get, okay, so you simply do get the entire interest, the entire dividend, okay. Therefore, you do get the preferred dividend is equal to 5% times $1, the nominal value of the preference share, okay, to give us therefore 5 cents. Okay, so the preferred dividend is 5 cents. Next, we do need to get the P note. Okay, we need to get the ex-dividend market value of those preference share. Okay, so that's there. But first, going back to a question. Okay, going back to a question. If we told that the market value of the preference share is equal to $6.25 million. Okay, $6.25 million. And the nominal value of the preference share is equal to 10. The one preference share has a nominal value equal to 1. Okay, which implies therefore the number of preference shares issued, okay, is simply 10 million. Okay, therefore, having known that the number of preference shares issued is equal to, okay, so the market value per preference share NPS is equal to the total market value 6.25 million. We divide by the market value by the number of preference share issued, which have just obtained to be equal to 10 million. Therefore, the market value per preference share will be equal to 62.5 over cents, okay, or 0.625 over dollar. Therefore, the cost of the preference share, we see the preferred dividend, which you got 5 cents, divide the market value 62.5, and of course we express this as a percent to give us how much be the cost of the preference shares. Okay, and we do get 8%. Okay, we do get 8%, therefore, to be the cost of the preference shares. Okay, so you've done all that bit, trying to identify where the money came from, trying to know the cost of capital from each of those finance or those capital sources. The next bit, of course, we get the market value. In this question, the market value is only given to you. Okay, so that bit you don't calculate. Okay, so simply go to our last step. Okay, step 4. Okay, step 3. Okay, this is done for, in the example. Okay, and step 4 is determining company weighted average cost of capital. The money came from equity with a market value of 125 million. Okay, 125 million is the market value of equity. We multiply by cost of equity, which we got at, can't remember, it was equal to 10%. Okay, we have it here. It is equal to 10%. Okay, equal to 10% times 10%. Plus the company also got finance from preference share with a market value of 6.25 million and a cost of 8%, times 8%. The company retained money also from bond with a market value of 21 million at a cost equal to, we have it here, 6.41 times 6.41%. Okay, and that's therefore and the total market value. Okay, so maybe we can just have a side working for it. Okay, so total market value. Okay, market value from all those sources. Okay, market value. Okay, total. And you have equity, you have bond, and you have preference share, which is equal to 125 million, a bond 21 million, and this for preference share 6.25 to give us therefore total market value equal to 150. 153.25, confirm. and get 152.25. Thank you, Sharon. So 152.5. Okay. So divide therefore by 152.25 million. Give us a cost of how much? Okay, to give us a cost equal to 9.42%. Okay, 9.42%. Therefore, the cost of capital for this particular company. Okay, so it's that easy. Okay, so determine where the money came from. Next step, trying to get the cost of capital from each of those capital sources. That step, determine the weight. And now fourth step, apply the weight you have just obtained to get the contribution of each of the capital source towards the company entire cost of capital. And of course, you add the total from each of those capital sources. Okay, simple that. That's how easy it is when it comes to getting the cost of capital. Now, I want you to go through one of the question here. Okay, there are five questions, but we shall do three. We shall do two. The others I will ask you consider it as okay your takeaway assignment. Okay, to go through their question. So I would want as we go through. Let me check what question it is. Yes, question 5. Okay, so go through question 5. I want to split you into groups. Okay, I want to split you into groups. Okay, groups of 3 people. I think 3 is going to be better. Okay, so group of 3 people. Go through the question. Okay, attempt it. Okay, try to as much as you can. Okay, not that I'm going to check what you have done, but for your own sake. Okay, so in group of 3. Okay, so we have more or less in this case 7 groups. Okay, go through question 5. Okay, attempt it. You can discuss. Okay, in that group I'll assign. Okay, and you come with an answer. Okay, so I'll be asking you from each of the group you make a contribution. Okay, so I'm splitting you up into groups of 3. Okay, so it's simply on random basis. Okay, it's simply on random basis. Okay. Okay, I presuppose that you have been able to discuss in detail, okay, in your groups, okay. So to begin with, okay, so I just want you, the group you are discussing, okay, to share your ideas, okay, on what you think you should have done in that particular question, okay. So let me begin with, so just pick on random basis, okay. Asma.
Yes.
Yes. What did your group discuss?
I go through the steps.
Yeah, what you did, yes.
Okay. First, you identified the costs of finance that are in this question. And then we found 4 of them.
So you obtained 3 or 4 finance sources?
3 actually, and then we assumed that we ignore long-term borrowing since it has a...
Okay, fair enough. Continue. So these 3 sources include
ordinary shares, preference shares, and loan notes.
Preference shares, and you have the bonds. Okay.
Yeah, the bonds.
Okay. Next, what do you do?
We calculate the cost of equity, like the cost of each of them.
Okay, cost of equity. I'm not sure. Can you be able to share?
No, I was doing it in my book.
Okay, you're doing it on your group. Okay, fair enough. Then take me through on the first one was on
Cost of equity.
cost of equity. Okay, so what model did you use? Cost of equity.
The dividend model.
Okay, the dividend model. Okay, so therefore, cost of equity is equal to D naught. Hope you can see my screen.
Yeah.
Okay, plus the growth. Okay, fair enough. What next?
So we are looking for the dividend per share for the year 2007.
So the dividend per share for the year 2007. Okay.
So we have been given ex dividend and cum dividend. So we can look for dividend per share.
Okay, so you've been given the cum dividend, which is equal to 7.52, and you were given the ex dividend to be 7.07. Okay.
Yeah.
So from there, you were able to get the dividend.
Yeah, the dividend per share, which was 0.45.
So 7.52 minus 7.07.
Yeah.
And you got 0.45.
Yeah.
So this is D naught or D1? What is it?
This one, it's D naught.
It's D naught. Okay. So let me stop there. Let me just, so that I can critique what you have just done. So this should be told, has it been paid or not paid yet?
It will be paid in the near future.
So it will be paid.
Yeah.
So is that D naught or is that D1? Essentially, don't forget, since it has not yet been paid, okay, don't forget this 0.45 will be paid in the near future, okay, so it cannot be, it can we say, essentially, it is going to be, if, don't forget, D naught is the most recently paid dividend, okay, D naught is the most recently paid dividend. However, the shares of the company are trading come dividend. Okay, the shares of this company are trading come dividend. Now, what does that imply? It implies therefore that the company, okay, or this share are going paid maybe the next 2 weeks, in the next 3 weeks. Okay. So if they will be paid in the near future and the share is not yet trading come dividend, then that will become therefore D1. But since the share price has already done that incorporation, okay, they have now become for D naught. Okay, so thank you for that. Yeah, this therefore is our D naught, not D1. Okay, D naught, not D1. It's a D. It is D naught. Okay, so thank you also for that. Let me go to another group. So this therefore is our D naught. Thank you also for that. Okay, go back to check someone else. Winnie. So your
Yes.
group, what did you discuss?
We discussed on
You
the
pick
cost
from
of
cost of equity.
yeah.
Okay,
Yes.
so pick from where Asma has left.
From there we determined the growth rate.
So the growth rate, so G, okay.
Which we found to be.
How do you get the G first?
It's the dividend, the current dividend over the last year dividend.
So the current dividend was how much?
Which is 0.43 over 0.37 raised to
So
1 over 4 minus 1.
So 0.43 divided by Winnie. We lost you.
0.37.
So sorry, it was you divided 0.43
divided by 0.37
or 37.
0.37.
How many years of growth were there?
4.
4 years.
So over, yeah.
So the 4 years. So 0.43 divided by 0.37 to the power of
1 over 4 minus 1.
1 over 4 minus 1. Okay, so we need just a question before. So here, don't forget here we do have, if we are to use 0.43, if we are to use 0.43, okay, that is the dividend for 2016, isn't it? However, don't forget we have the 2017 dividend, isn't it? That we have the 2017 dividend, the one that Asma has just given us, the 0.45. So you didn't use that one, isn't it? 2017, we have a dividend. 2017, don't forget, you have a dividend equal to 0.45, isn't it?
Yes.
Yeah, so essentially, therefore, you are meant to have used it, okay? You are meant to have used it because we have the dividend from 2013 all the way to 2017, isn't it? Yeah, and in the years of growth, okay, as per your model, they're meant to be 4 years, 2013, 2014, 2015, 2016, and 2017. So you have 4 years of growth. Okay, that's okay, what you've used, okay? Because there are 4 years of growth. So just here, 2013, 14, 15, 16, 17, okay? There are 4 years of growth, 13, 14, 14, 15, 15, 16, 16, 17, that's give us 4 years of growth, okay? However, don't forget, you're meant to use the 2017 dividend, okay? So we need, so here, don't forget, Winnie, can you hear us? Winnie.
Yes, I can hear you.
So what should be the G now? Don't forget, you're meant to use you're meant to use from 2013 to 2017, 2013 to 2017. Okay, so that's 7 all the way to 45. Then we get therefore to the power of a quarter minus 1.
Yeah.
D. Therefore, should be the G. We have to use now our these figures here.
5.01.
5.01.
5.01.
5.01. Okay, so 5.01%. Okay, 5.01%. Okay. Now, next, what did you do? Winnie, next, what did you do?
Yes, and now we determine the cost of capital, of cost of equity.
The cost of equity, which is how much?
Which is the current dividends, which is 0.45.
0.45.
1 plus the growth rate.
1 plus the growth rate, 1.04501.
Over.
All over.
7.07.
Sorry, 7?
Okay.
Don't worry, you're going, it's just learning. It's a learning process. Don't worry, Winnie.
Okay, over 7.07.
7.07. Okay, that's correct. Don't forget, we are meant to use
plus the growth rate.
Yeah, so don't forget, you're meant to use the X dividend. So don't use 7.52, but 7.07, the X dividend market value. So plus the growth rate, which is equal to which is equal to 0.0501. Okay. And let's give it for a cost of equity how much?
Oh God, 0.5.
Not just from Winnie, from any person. Okay, then we get 11.68. Okay, 11.68% cover for the cost of equity. Okay, thank you, Winnie, for that. Susan.
Yes.
Okay, so we have done the cost of equity. Okay, from those two groups, they have given us what the cost of equity is meant to be. So what next do you do?
We did preference shares.
Okay, so next, so that was A. So B, cost of preference share. Okay, so cost of preference share. Okay, how did you do that?
So we use the formula of D over P naught.
So D, 100. We divide by P naught, we express that as a percent. Okay, fair enough. Next, what did you do?
So we used the P naught was 0.31.
So P naught, just a minute to Susan. So P naught equal to, so the current market value of the preference share is equal to Use what? What did you use? Sorry.
0.31.
So 0.31, yes. Okay. Then next, what did you do?
The DP, we used the 5% preference shares.
So 5%, okay.
Times 0.5. Times 0.5.
Times 0.5. What is 0.5?
Let me go back to the slide. The 0.5 is the nominal value.
0.5 is the nominal value of those preference share. That is correct. That's true. What next did you do?
So we got the DP is 0.025.
So you got 0.025 or 2.5%. True. Next.
And then so the next thing was to find out the preference shares, which we did the 0.025 time over the 0.31 times 100.
So for the preference share, you used 2.5 divided by that one. Okay, in percent, you got what?
8.06.
8.06. Okay, and get 8.06%, therefore, to be the cost of the preference share. Okay, thank you, Susan, for that. I'm presupposing that all of you also did get that. Okay, when it comes to getting the cost of preference share. Okay, so the next, okay, so let me pick another person. Okay, Stacy. This is Stacy Kihuri.
Yeah.
Yes, Stacy, what did you do on your group?
I wasn't in a group.
You aren't in any group?
Yeah.
Oh, okay. Sharon. Sharon.
Yes.
Yes. Okay. So you've done the cost of equity, the cost of profit share. What else did you do?
That's where we reached. We're in the same group with Susan.
Oh, are you in the same group?
Yeah.
Okay, fair enough. Okay, let me take someone else. Innocent. Innocent?
Yes.
Yes, Innocent. Take us a step further.
I was in the same group with Winnie, I think, so we had reached there to the point of preference shares.
Oh, you're in the same group with Winnie. Okay. Maureen, where's your mic? Oh, okay. Naomi, hey, you should have your mic somewhere. Kami.
Yes.
Yes, in your group.
I wasn't in any group, but I did it alone.
Okay, fair enough. So what extra did you do?
I tried on loan.
Cost of bonds or the notes?
Bonds, sorry, bonds.
Okay. So cost of bonds, okay. What did you do?
I first looked for the interest after tax.
So the interest from this bond, okay, it was equal to how much?
7% times 100 times 0.7.
7%. So this bond, just to check on those figures. So the bond we have here, okay, it is paying interest at a rate of, is it? Yes, it is paying interest at 7%, okay, with a nominal value of 100. And do you pay tax?
At the question they said calculate after tax.
Yes. Okay, yes, there is a 30% tax rate here. Yes, thank you, Kami. Okay, so going back, so times 1 minus 0.3, okay, which you got?
4.9.
So you get the interest to be equal to 4.9. Thank you. Okay, what next?
Then I calculated the IRR.
Okay, so the market value. So what is the market value of this bond first?
Market price is 102.34.
102.34. Yes, so you have 102.34 to be the market value of this bond. So 102.34. Okay. So you did say, okay, that P naught 102.34 is equal to the interest 4.9 times present value factor. How many years to redemption? Is this bond redeemable or convertible?
It's redeemable in 4 years' time.
It can be redeemed in 4 years' time. So N is equal to 4. Okay. So redeemable in 4 years' time. Okay. So 4 years, R% plus redemption value. What's the redemption value?
I actually used the the PO.
Oh, use the PO. Okay.
Yes.
Okay. So maybe that could have been a mistake because essentially, don't forget, in the final year, okay, the company, okay, if you go to the question, if you just check on the question, okay, it is telling us in the final year, they can be redeemed in 4 years' time, okay, at 5% premium to their nominal value, okay, at 5% premium to the nominal value. So in the fourth year, okay, you don't get the market value, you get the redemption value because market value is today, year 0, okay. So in the fourth year, you get a redemption value, okay, which is 5% premium to the market value, okay. So just to take note of that, okay. So let me correct that. So redemption value is 105% to the nominal value. The nominal value is 100. So therefore, redemption value therefore will be 105. Okay. Okay. So come and take us through with our new figure. So 105. What do you do next? So 4 years R%. So maybe that's the mistake you did there. Okay.
Yeah.
But so far so good. Okay. Thank you, Kami, for that. Let me check someone else who may have used the correct figure. Thank you, Kami, for that. Maureen. Maureen is not there. Louisa, I think you're in the same group with Maureen. Louisa? Yes, Louisa.
Sorry, where were we? On the loan notes?
Yes, on the notes. Okay, Kami has taken through all the until where we have the market value, the quotation. Okay, trying to quote how you get the market value of 102.34. Okay.
Okay.
Then what did you do?
So now we use the IRR method because we have the market, what do you call it? The market value.
Okay.
We have the interest. And we have the redemption value.
The redemption value, okay?
Yes.
So what trick did you use?
I checked first checking whether what it would be if it were an irredeemable bond.
Okay, so let me just put that note somewhere, okay? So this just, if the bond was irredeemable, the cost would be equal to, what did you do? You did what?
The interest.
The interest, which is equal to?
Which is 4.9 over the P naught.
Over P naught, which is?
Sorry, is it P naught? Over 105. 105 is the redemption value. So I should have used the P naught. So I think I used the wrong thing. I should have used the P naught, which is 102.34.
You used 102.34?
Yes.
That's what you used?
Yes.
Okay. Yeah, which is the correct thing because we are meant to, it is meant to be the interest, okay, which is 4.9. We divide by the market value, okay, with the P naught, okay, market value, which is 102.34, okay. Yes, that's what you meant to be your dad. And you got what? I
got 4.79%.
So you get 4.79%. So by that, for the others, don't forget this step. You don't need to do it. You don't need to show it in your final answer. Okay, you don't need to do it in the final answer, but it's just for you to have an idea what or where. Okay, your cost of debt should be. Okay, so essentially the cost of this debt should be roughly 4 point something. Okay, so that's just to ensure you don't have very many trials. Okay, thank you, Lisa. Continue.
So that informed my first trial, which was at 5%.
So our first trial at 5%. So at 5%. Okay, so we got so the to quote is negative 102.34 plus 4.9 times present value and factor 5 years, no 4 years, sorry.
Yes.
Okay, 4 years, 5%. Okay, plus redemption value, okay, which is equal to 105 times present value interest factor, 4 years, 5%. And the sum gave you what?
It gave me positive 1.42.
1.42. Okay. Positive 1.42. Okay. Then the second rate
Then
is?
I tested at 6%.
Okay, at 6%, the same process, but now at 6%. Okay.
Yes.
So negative 102.34. Let's repeat for the others. 4.9 times present value factor. Okay, 4 years, 6%, plus 105 times present value interest factor, 4 years, 5%. And you got what?
I got negative 2.19.
Okay, so here you got negative
2.19.
19. Okay. Don't forget for the others, in case the figures that we have here contradict what you had, forget you let me know. Okay. Just there's someone whose hand was up. Let me just check that, Louisa, before we proceed.
Okay.
Michelle, yes. Michelle?
I have two questions.
Yes, two questions. Yeah.
Yeah. First, on the cost of equity.
On the cost of equity. Yes, okay. Cost of equity.
When you are calculating the growth rate.
When getting the growth rate. Yes, the growth rate, sure.
Even if the dividend has not been paid.
Even if
it
yes,
does,
yes.
It does not affect how we calculate it. Okay, for me, I used 0.43 over
0.37.
37.
To the power of a quarter. A
third, yeah.
Yeah, essentially, okay. I don't think the figures should be going to be too material. You can also use the D2017 or 2027. Okay, so you can use the D2017 as your numerator. Okay, and the 0.37. Okay, I don't think they're going to be too material. There's going to be a huge material difference between those two rates. Okay. But I propose, okay, you can use the D note, okay, since the value of the shares of this company is trading come dividend, okay, I propose use 0.45 as opposed to using 0.43, okay, but I don't think you're going to have material difference. Okay, what was the G by using 0.43?
5.14.
5.14.
Yes.
Yeah, okay, so I don't think they're going to have too much material difference. Okay, you can still go ahead with it. Okay, but essentially, I would propose you use the D note. Okay, the D note. Okay, even if it will be paid in the next maybe 2 weeks or 3 weeks or 4 weeks. Okay, because the share is trading come dividend. Okay.
Okay.
Okay. Are there a question?
The preference shares, the question says
yes,
they are irredeemable.
Oh, they say that they are irredeemable. Yes. Okay. The question, what was the question?
When calculating the cost of preference shares,
yes,
I subtracted, I removed the tax.
You remove the tax.
Yeah.
Essentially, when it comes to the preference shares, the assumption that we normally make is that there's no tax on the dividend, okay, that is paid to the preference shareholders. So we ignore the tax, just the same way we did ignore the tax when it comes to get the cost of equity. We also ignore the tax, okay, when it comes to the preferred dividends. So we ignore the tax, okay. Why did you consider it?
Sorry?
Why did you consider tax in the preference shares?
Okay, I used the formula interest over P note.
Now, when it comes to the preference share, okay, so the preferred shareholder don't get paid interest. They do get paid what we refer to as the preferred dividend. Okay, so the preferred dividend, okay, in that context, okay, there's no tax on it. Okay, so it's not an interest as per se. Okay, You can, I know where you may have got it wrong, okay, on the preference, because the rate of the dividend is a percent, okay. Maybe that's why you did confuse, okay. The rate of the dividend is on a percent. That is always apply for the preferred the preference shares, okay. However, what is being paid is not an interest, but it is a dividend, okay. And that's why we don't put the tax, okay, because it is a dividend, just like the case of equity share, okay.
Okay.
Michelle, yeah, so you don't tax the preferred dividend, okay? Even though they are paid based on a percent, just like the case of the case of the loan, okay? But as per se, it is not an interest; it is a dividend, and the dividend is a percent, okay? So don't tax the dividend. Okay, Michelle.
Okay, thank you.
Okay, I hope I answered all your questions.
Yeah, you have.
Okay, there seems some other people here who have questions. We have Lois. Lois?
Yes.
Yes.
On the cost of equity.
On the cost of equity, yes.
Is 0.45 D0 or D1?
Okay, so is 0.45 D0 or D1? Okay. Let me repeat on what I said. Now going back to the question, now this question is telling us, okay, going back to the question, is that the dividend, yes, there is some, yeah. If you check, okay, the share price of this company, okay, account dividend market value is 7.52, okay. The market value of the market price of this share is 7.52 come dividend. Okay. Now here, for the share to become dividend, it means therefore the share price will be paid in the near future. Okay. And as I mentioned, it can be in weeks. It can be most likely to be in weeks. Okay. Not it would be more than a month or less. Okay. It is going to be in weeks. Okay. Now what that implies that essentially, okay, since the dividend is getting paid in the next maybe 1 month maximum period, okay, and they imply therefore you do, if you discount back to your zero, if you discount by 1 month back to your zero, there will be no material difference between that dividend and its present value. And let me just try to illustrate in, okay, to illustrate in, let me have a board here. If, for example, the dividend is getting paid, in this case, it will be 0.45, and so it will be paid in the in month of June. If we discount it back to your zero, okay, if we discount it back to your zero, okay, your zero means today, okay, by 1 month, okay, this value and its present value as it may is not going to be any different. If anything, it's going to be 0. I don't know, 4, let me say, like 449, okay, just an example, okay. Therefore, materially, okay, when it comes to get the present value, you don't need to discount it back to your zero, okay. Why? Because its present value in quote, okay, and the value in the month of June, a month from now, there's no difference, okay. Therefore, this 0.45 we do consider as D naught. So once we see the share price is come dividend, then that dividend is our D naught, not D1. But if, let's make a note, but if the share is yet to reflect the potential dividend to be paid, okay, the share price is yet to reflect the potential dividend to be paid, then we consider that dividend as a D1. If, for example, this 0.45, okay, this 0.45 is getting paid in the month of, let's say, September, okay, it's getting paid in the month of September, and the share price is yet to reflect, okay, not yet reflected, okay, this is not yet reflected on the share price, then we do consider this is as D1, not D0. Okay, once that dividend get reflected on the share price, then we say that that's a D0. If it is yet to be reflected, okay, that's therefore comes of a D1. Okay, so how that's clear, Alois, on the difference, yeah. Okay, therefore once we see that the share price is come dividend, okay, then that dividend is a D0, not D1. But if that dividend is yet to be reflected on the share price, then that's a D1. And it's going, and it is going paid in the next 1 year. That's a D1. Okay, it's clear, Louise, I hope.
Yeah, thank you.
Oh, okay. There's someone else who was it? Okay, I think I've answered all the question. Okay, back to you, Louisa. It's Louisa now. Okay. I'm trying to look for you, Louisa. Yes, Louisa. Yes, she is.
Yes. So
Yes.
we had gotten the value at 6% to be negative
To the
2.19.
negative 2.19. Yes. Okay.
So plugging in the IRR formula.
So I had a formula 5% plus 1%. The value at 5%, we got 1.42. So 1.42 divided by 1.42 minus 2.19. Okay. Yes. Okay.
Yes.
And you get what?
5.39%.
5.39%. Okay. Thank you, Louisa, for that.
And in my case, I also took bank loan as a source of capital.
Okay,
so I had 4 sources. Yes.
So you have bank loan, cost of bank loan. Okay, just make a comment for the rest. Okay, don't forget here. Let me share the question again. Okay, we have the bank loan. Don't forget this bank loan. Okay, it's a long-term bank loan. It's a long-term. Don't forget the reason why we ignored the overdraft, okay, in the other example. In the other example, don't forget we never considered the bank overdraft. Why? Because it's a short-term finance source. However, the 10 million bank loan we have here, okay, it is a long-term borrowing. It is for more than one financial year. It is not a short-term loan. Which implies, therefore, we ought to consider it as a capital source, okay? Not as if it is financing the company, short-term finance need. We are financing, it is being used to finance the company. It is being used to finance the company, long-term needs. Therefore, we ought to consider it in your analysis, okay? So the 3 million bank loan, we ought to consider it, okay? So, Louisa, next, what do you do?
So since we were told that it has a variable interest rate,
yes,
I went back to how to estimate the interest rate of a variable loan. And I took it that the loan note is a proxy of that other loan. So I took the same value of 5.39%.
Yes, and that's very good. That's how you meant to do it. Okay. Don't forget, this loan is a variable interest paying loan. So therefore, I think I gave the criteria. Okay. You can use its previous history. Okay. You can use maybe what's the interest you will be paying in the next 1 year in case you have the prediction. But since you don't have either of those things, what do? You're going to be using, does this company has a similar debt instrument? It has a debt instrument here. In this case, it has a bond. Okay. Therefore, we assume, okay, it is an assumption, okay, the cost of this bank loan, okay, is going to be equivalent to the cost of the bonds. Therefore, we will be using 5.39%. Thank you, Lisa, for that. Okay. Now, having done all those, okay, those 4 sources, now we're simply not going to weigh them. Okay, we are simply going to be weighing them, all of them together. Okay, therefore, we get the market values. Okay. So weighted average cost of capital for this company, it has equity. And the cost of equity from what you've just done, okay, is 11.68. So 11.68%, we multiply by the market value of equity. I think in this case, we need to get the market values because it's not given to us. So we need to estimate the market values. Yes, so we need to have that working. Okay, so that are working for market values. Okay, and just have it here down. Okay, so market values and so next workings. Market values. We begin with equity. Okay, let me get a group. Esther.
Yes.
You did the workings for the market values, isn't it?
No, not really.
You didn't do that?
I didn't get there.
Okay. Ebontane. Ebontane.
Yes.
Yes. You must have run the workings for the market values.
We didn't get there.
You didn't get there? Oh, okay.
Yes.
Okay. Let's do it together then. Okay. Okay, so the market values, okay? The market value of equity, okay? So going back to the question, is equal to the market value, okay, per share, which we got, where is it? Is 7.07. Don't forget, don't use the CAM dividend. We use the X dividend, the 7.07, okay? So again, we go to 7.07, okay? 7.07. We multiply by the number of issued shares. So coming back here, we need to determine how many shares has this company issued. The nominal value per share will be told is equal to 0.5. 0.5, okay? And be told that out of the 17 million we have here in the balance sheet, the 12 million is what is for equity, is what is for share, and 5 million is for the bonds, for the preferred share, okay? So 12 million is for the ordinary share capital. And one share has a nominal value of 0.5. Therefore, how many shares has this company issued? It is 12 million divided by 0.5, okay? 12 million is the total nominal value of equity share. The nominal value per share, 0.5. Therefore, how many shares do we have? 12 million divided by 0.5 to give us 24 million, okay? Therefore, 12 million divided by 0.5 to give us, therefore, the number of shares this company has. To give us the market value of shares of this company to be how much? Be careful, use the X dividend, not CAM dividend. Be careful there. Else we can make a mistake. Yeah, what's the total market value of the shares of this company? Okay, let's see to get here. We get 169.68 million. Okay, thank you. Huh? Daniel, check the answer maybe. Is it 169 or 168? Okay, so it's supposed to be 169.68 million to be the total market value of the company equity. Next is we get the market value of preference shares. Okay, so market value of preference shares, which will be equal to the market value per preference share. Okay, so going back to the question, the market value per preference share will be told is equal to 0.31. Okay, so 0.31. So 0.31. So 0.31. We multiply by the number of issued preference shares. Okay. So issued preference share, as per the question, it be told that preference share has a nominal value of 0.5. Okay. So let me erase these ones. You can get to see where am I writing. So the nominal value per preference share is 0.5. Then total nominal value is 5 million. Therefore, the number of issued preference share is 5 million divided by 0.5. Okay. Therefore, we multiply by the number of preference share issued, 5 million, we divide by 0.5 to give us the number of issued preference shares, to give us 10 million. So 10 million times 0.31 to give us 3.1 million. Okay. Next, hope with 3.1 million, I hope I have not done anything wrong, is we get the market value of the company bonds. Okay. 3.1. Thank you, Evelyn. So the market value of the bonds. Okay. The market value per bond, okay, market value per bond from the question, to be told is equal to 102.34. 102.34, the market value per bond. Therefore, okay, 102.34, we multiply by the number of bonds issued. Going back to the question, okay, you'll be told that the borrowing company 10 million is a note and 3 million is a bank loan. So we are concerned with the note, 10 million. Okay, 10 million, the total nominal value. One note or one bond, okay, has a nominal value of 100. Okay, therefore from there we can now be able to estimate what should be the number of bonds issued. Therefore, it's 100 million. So it's 10 million. Sorry, 10 million. We divide by the nominal value per bond, okay, which you'll be able to get is 100. Let's give therefore 10.23. 10.23 become therefore the total market value of company bonds. Okay, so 2.34 times 100,000, the number of bonds issued in this particular market. Okay. Next, don't forget you have the bank loan. Sorry, the bank loan. Don't forget the bank loan has no market value. So simply we use a book value which is equal to 3 million. And that give the total, will give therefore what should be the total market value, okay, of all those 4 finance sources. To give us how much? Okay, to give us a total equal to 186.01. Okay, 186.01 to be the total market value from those sources. Okay. Thank you, Maureen. 186.01. Okay. Now here we see the company has 4 sources. Okay, we begin with equity, which you got the cost to be equal to 11.68. We multiply by the market value of equity, which you have now here 169.68. Okay, million, plus the cost of preference share, which we got, I think 8%. We got what? Yeah, is it? Yes, we got 8.06%. So 8.06%. So 8.06%. We multiply, sorry, 8.06%. We multiply by the market value of preference share, 3.1 million, plus the market value of bonds, the cost of bonds, which we got 5.39%. The market value of bonds, we got 10.234 million. The cost of bank loan, 5.39% times the book value, 3 million. All that we divide the total market value, which is equal to 186.01 million. To give us a cost of capital for the entire company equal to how much? And you get 11.17%. Okay, 11.17%. Okay, so 11.17% will become therefore the cost of capital for this particular company. Okay, so I guess we have done more than enough question. I hope everyone is comfortable. As I mentioned, don't forget, you may end up finding this question. Okay, so you may end up finding this question. Okay, but it's quite an easy question, I guess. Okay, so simply get to know where the money is coming from. Okay, who is financing the company? Okay, who are the capital providers? Once you done that step, the next step, of course, is to determine. Okay, determine the cost of capital. Okay, from each of those providers of capital. Okay, next bit, of course, you get the weight, and once you have the weight, you simply apply the weight on each of the financiers. Okay, I think quite easy. Okay. Question? Okay, Luke, you have a question. Okay, so let me come back to you, Luke. Mosoti, that is Luke now. Yes, Luke.
I have a question.
Yes.
In the question bank, similar questions of weighted average cost of capital.
Yes.
There's some bit where they include flotation costs.
Yes, tell us, where is that? Which question is that?
May 2014 question 4B.
Okay, May 2014. For the rest, we can refer to that sheet in May 2014 question.
4B.
May 2014 question 4B. So May 2014 question 4B. Okay. So look, you want us to do that question? Okay, fair enough. Then I think we can do that. Okay. So May 2014 question 4B. That's what Luke wants us to go through. So take 2 minutes, then we can discuss that question together. May 2014 question 4 part B. Okay, so I presuppose that you have learned the question, okay, that Luke wants us to attempt. Okay, so in this question, you're being asked to get the cost of capital, okay, for the company. And this company, it seems to have three finance sources. It has share capital, it has preference share, it has the debenture, okay? And you'll be given some sort of information there from which to estimate the cost of capital, okay? So as the same step, okay, we get the cost of equity, we get the cost of preference share, and the cost of the debenture, okay? So it can be the first one, cost of equity. So this is May, sorry. So this is May 2014, question 4, part B, okay? So can we get in cost of equity? So cost of equity. And as per the information given here, okay, we can say that in note 3, you've been given the return on the market, you've also been given, okay, the stock beta, okay? So that implies, therefore, we're going to be using the capital asset pricing model, okay? Therefore, you can see the cost of equity as per the model, okay, is equal to risk-free, is equal to equity beta, return on the market portfolio minus the risk-free return. Risk-free, that is return from the government-issued securities, okay, as per note 3, we have the T-bonds, okay, with a return equal to 12%, and that can therefore the risk-free rate of return, okay. Don't forget the risk-free is simply the return, the risk-free assets, okay, normal yield, okay. And in this case, the risk-free assets are the government-issued securities, okay, the bonds. Equity beta for this stock is 1.5. The return of the market, we told, is 14% minus 12%, the risk-free rate of return, okay? And that will give us, therefore, 15%, I guess. Confirm whether we get 15%. Okay, and we get, yes, we get 15%, therefore, to be the cost of equity, okay? That's part A. Then B, we need to get the cost of preference share. So cost of preference share, cost of preference shares, RP is equal to the preferred dividend. We divide by P naught, of course, we express as a percent, okay? Therefore, we need to get the preferred dividend. And in question, in note number 4, preference share can be sold at 120 with a dividend of 12, okay? So dividend equal to 12, okay? And a cost of flotation equal to 6, okay? Therefore, P naught, or rather, the amount to be received, let me just put here in asterisks, okay? P naught less flotation cost. We've been told that in case the company goes to the market right now, okay, to obtain capital by the issue of preference share, okay, every share they're going to issue, they're going to be issuing at 120, okay, they get 120. However, not all that money, they're not going to get the entire 120 because there are some costs they were incurring, okay. For every share they issued, they incurred a cost of 6, okay. It implies, therefore, the net amount of money they're going to be receiving from the issue is given 120 minus 6. Okay, 120 minus 6. Therefore, the net amount they shall be receiving from an issue is equal to 114. Okay, the insurance, sorry. Okay, so you get 114 shillings. Okay, was that clear? The company is issuing one share for 120. However, They didn't get the entire 120. They only got 114. Okay, that's come therefore our denominator. Therefore, okay, you're not going to use 120. We're going to use 114. Okay, therefore the cost of profit share for this example will be the dividend 12 divided by 114. We express this as a percent. Okay, so it's going to be less the issue cost. And you get how much is the cost of the profit share for this company? Okay, and we get 10.53. We get 10.53% be the cost of the profit share of this company. Okay, now we need to remove the issue cost. Okay, the denominator will only be the total amount to be received after the issue cost. Okay, so therefore 120 minus 6. Okay. Okay, so having done that, next this company has a debenture. So say cost of debenture. Okay, and this debenture, as per note 7, the company will sell how much? Will sell 12% debenture with a maturity of 10 years at 90. Okay, so their par value is 100, but they're being sold for 90. That's the market value. So P naught is equal to 90 shilling. The nominal value, okay, is 100. Okay, that's already given. The nominal value per bond is 100 shilling. And they are 12%. Okay, so they are being issued 12%. Therefore, the interest the holder shall be getting for the next 10 years, okay, is 12%. Does we pay tax? Oh yeah, we do pay tax. In note 5, there's tax. So 10% times 100. However, there is a tax of 30%. Therefore, the net interest income to be received is given 12 times 0.7 to give us 8.4, I presuppose. Okay, I get 8.4 shillings to be the net interest income to be received by the holders. Okay, to be received by the holder. Okay. Having done that, I think now we have all the variables we need in order to get the cost. And yet the number of years to redemption is 10 years. So N is equal to 10 years. Therefore, so the market value 90 is equal to the interest 8.4 times present value and factor 10 years R% plus redemption value. If not been told about redemption value, we assume redemption will occur at the par value of 100. 100 times present value interest factor 10 years R%. Okay, try another method. 8.4 divided by 90 in percent. What do you get? What will be the cost of this bond if it was be irredeemable? 8.4 we divide by 90 in percent. We get 9.33. So we can begin at 9. So we can have our first discount rate at 9%. Okay, so at 9%, it will be negative 90 plus 8.4 times present value and factor 9%, 10 years. Redemption value is 100, present value interest factor 10 years, 9%. What do you get? Okay, and we get 6.15, 6.15 positive, I suppose. Okay, 6.15. Okay. Now, what if we discount the same cash flows, but now at 10%? Okay, so at 10%. Okay, this is a second discount rate. Okay, it'll be equal to the same process 8.4 times present value factor 10%, 10 years, 100 present value interest factor 10 years, 10%. You get how much? You get 0.165 positive. Okay, 0.165. Okay, now you have the two discount rate. Now that's in me, therefore we can now be able to get, by use of IRF formula, we can get the cost of this debt. Okay, so RD will be equal to 9%. 1%, the value is 9%, we got 6.15. 6.15 minus the value 10%, 0.165 to give us. Okay, and we get 10.03%. Okay, yeah, we haven't done that. Now we need to get the market values. So next we need to get the market value. Okay, so more like step C. Okay, so the market value of step number 3, to get the market value from those 3 sources. Equity, the market value per share, we've just been told as per note 2 is 80. Okay, as per note 2, the market value is 80. We multiply by the number of shares issued. The total nominal value of the shares of the company is 80 million. 80 million. The nominal value per share is 100. So divide by 100, and this gives therefore 64 million. Okay, 64 million to be therefore the market value of the equity shares. Okay, then we get the market value of preference share. Okay, so preference share of the company. Then market value per preference share as per note 4. We got the market value of preference share to be 120. Okay, the value at which the one share can be sold in the market is 120. Here, don't net the not 114. P not to forget is 120, the market value. So 120 we multiply by the number of preference shares issued. The total nominal value is at 5 million. The nominal value per preference share is 100. So 100. So get how much with the market value of preference shares. So we get 42 million. We get 42 million. Okay. Then get the market value of the company debentures. And the company, going back to the company debentures, the market value between they can be issued in the market at 90. So the market value 90 times the number of debentures issued. The nominal value of the debenture is 27 million. We divide with the nominal value per debenture, which is 100, to give us how much is the market value of the debentures.